When prices rise overnight, jobs feel uncertain, and bills keep climbing, money stress shows up fast. So here is the real question. When the future feels shaky, what should you do with your money right now? In this video, we shall explore 5 financial rules that help you stay steady during uncertain times. These rules are simple. They work for most incomes. They focus on control, calm, and clear next steps, not panic. Let's get started. 1. Build an essentials first budget, then adjust everything else around it. When life feels uncertain, your first job is to protect your basics. That means you must separate essentials from extras. Essentials are the bills that keep your life running. Housing, utilities, basic groceries, transport to work, and minimum debt payments. Everything else comes after. Many people make budgets that look good, but fail in real life because they treat wants like needs. In uncertain times, this becomes dangerous because one surprise can knock the whole plan over. The fix is not to cut all fun forever. The fix is to go into essentials mode for a period of time so your foundation becomes strong. Start by listing your monthly income, then list your essentials. Be honest. Do not guess. Use your bank and card statements. Add the minimum payments you must make on all debts. Add the true cost of groceries, not the ideal number you wish it was. Now compare the two totals. If the essentials take too much, you do not need shame. You need a plan. Look at the extra spending and reduce it for now. Eating out, shopping, subscriptions, impulse buys, and upgrade can pause. You are not quitting your life. You are buying yourself breathing room. A simple guide many people use is the 50-30-20 idea. About half for needs, some for wants, and the rest for saving and debt. In uncertain times, you can shift it. You might move more into savings and essentials, and less into wants until things feel stable again. The exact split is not the point. The point is that your essentials must be covered first, every month. To make this rule stick, use a weekly check-in. Pick one day each week, and look at your spending. This stops small leaks from turning into big problems. It also keeps you calm, because you stop wondering where your money went. 2. Treat your emergency fund like a bill you must pay. In uncertain times, an emergency fund is not optional. It is your shock absorber. Without it, every problem becomes a debt problem. A small accident, a medical bill, a car repair, a job delay. These things happen to everyone. The fund keeps them from turning into a financial spiral. If saving 3 to 6 months of expenses feels too big, do not start there. Start with a first safety step. Build a starter fund. Many people aim for $500 to $1,000. That amount will not solve everything, but it prevents many common emergencies from turning into panic. After you hit that first goal, you build the next level. 1 month of expenses, then 2, then keep going as you can. The timeline does not matter as much as the habit. The easiest way to build this fund is automation. Set an amount that moves every payday. Even a small amount counts. When money moves before you see it, saving becomes easier. You also remove the daily decision of whether you feel like saving. You do it because it is part of your system. One more rule inside this rule. Decide what counts as an emergency. An emergency is not a sale. It is not a vacation. It is not a new phone, because yours feels old. Emergencies are unexpected, necessary, and urgent. When you protect this fund, you protect your future choices. 3. Get control of debt before debt controls you. Debt becomes more dangerous when times feel uncertain. Interest keeps running even when your income slows. Minimum payments can trap your cash flow, and stress rises because the balance does not care how you feel. Start with clarity. List every debt. Credit cards, personal loans, car loans, store cards, anything you owe, write the balance, the interest rate, and the minimum payment. Seeing it all in one place feels uncomfortable at first, but it is the start of control. Then pick a payoff strategy. 2 common approaches work well. One approach focuses on the smallest balance first. You clear one debt quickly, feel progress, and gain momentum. Another approach focuses on the highest interest first. You reduce the cost of debt faster and save more over time. Both can work. Choose the one you can stick to. Now make it practical. Pay all minimums first so you stay current. Then put extra money toward your chosen target debt. Even small extra amounts matter because they reduce interest and shorten the timeline. Here is a powerful move many people forget. Ask for help from the lender before you miss a payment. If you are struggling, call them early. Many lenders offer temporary hardship options, lower rates, or payment plans. You will not always get yes, but asking early gives you more options than waiting until you are behind. Also, watch out for the debt habit trap. In uncertain times, people often use credit for daily life. Groceries, fuel, small shopping, delivery. It feels like survival, but it can quietly build a mountain. If this is happening, you need to adjust the essentials budget, reduce spending, and look for support so you are not using debt to plug gaps. Debt control is not about being perfect. It is about making sure debt does not block your next move. When you lower debt pressure, you gain flexibility, and flexibility is priceless in uncertain times. 4. Monitor your credit like it is part of your security system. Credit matters more than people think. It can affect loan approvals, interest rates, housing, and sometimes even job screening depending on where you live and what you apply for. In uncertain times, strong credit gives you options. Weak credit makes everything more expensive. Many people assume paying bills on time is enough. It is important, but it is not the whole story. You also need to know what is on your report and how your usage looks. Start by checking your credit report on a schedule. Look for errors, wrong balances, accounts that are not yours, late payments that do not match your records. Mistakes happen more than people expect. If you catch them early, you can dispute them and protect your score. Next, watch your credit card usage. If your card is near the limit, your score can drop even if you pay on time. A common guideline is to keep usage under about 30% of the limit. Lower is often better. One practical method is to pay your card more than once a month. For example, paying every 2 weeks can help keep the balance lower across the month. You can also set simple alerts. Many banks provide free notifications for credit changes or big account activity. Alerts help you spot issues quickly, and that speed protects you. This rule is not about obsession. It is about awareness. When you monitor credit, you are less likely to get surprised at the worst moment, like right before a loan, a rental, or a major decision. 5. Increase income in small ways, not risky ways. In uncertain times, cutting expenses helps, but income growth can help even more. There's a limit to how much you can cut. There's often more room to earn. Income growth does not need to be dramatic. Start with what you already know: your skills, your experience, your hobbies, your network. Look for one small way to earn extra each week or month. A few examples: freelance work related to your job skills, tutoring, selling a service on weekends, doing short projects online, offering a simple local service. Even small extra income can strengthen your emergency fund and reduce debt faster. If you have a job, consider negotiating when the timing makes sense. Research what others in your role earn. Document your results. Then ask for a raise or a better title. If the answer is no, ask what targets you need to hit and when you can revisit it. You can also invest in your ability to earn: a short certification, a course, or training that leads to better pay. Do not pick something random. Pick a skill that connects to jobs that actually pay more. This turns learning into a practical money move. The key in uncertain times is to avoid high-risk plans that promise quick money. Be careful with anything that feels like a shortcut. Focus on stable, repeatable income improvements. Small wins build confidence. Confidence builds consistency. Consistency builds results. These rules are not separate. They support each other. Essential budgeting gives you control. Emergency savings gives you safety. Debt control reduces pressure. Credit monitoring protects your options. Income growth increases your power. Uncertain times do not require perfect decisions. They require steady decisions. You do not need to do all 5 rules today. Start with one, then add the next. When you build a simple system, you stop reacting to fear and start acting with purpose. There you have it. 5 financial rules that can keep you steady, when the future feels unclear. If you follow these rules, you will feel more control and less stress, even if the economy stays shaky. Start small, stay consistent, and give your money a clear job. If this video helped you, hit the like button so more people can see it. Share it with a friend or family member who needs a simple plan right now. And subscribe to the channel for more easy, practical money videos that help you build a safer and stronger financial future. Thanks for watching.